What an end to the week we are having. Lots of red right across the board, but also notably the Mag 7 are being hit fairly hard. We have Alphabet down 4%, Meta down just over 3%, Amazon down 4%, Tesla down 3%, Microsoft also down 3%, Nvidia down just over 1%, even Apple, which has been fairly stable, also down more than 2%. Now, it was just a few days ago that Tom Lee said we are due a face-ripping stock market rally, where he put this down to Tesla making a massive V-shaped recovery, which will ultimately carry the S&P 500 even higher, and that is something we are yet to see. And year to date, it also has been fairly excruciating for a lot of companies. Again, notably the Mag 7 doesn't look like it will be their year, with Nvidia down around 18%. We've also got Tesla down 35%, and it was just a few months ago where Tom Lee said the S&P would end at around 6,600 points, with a large drive in the middle of the year to around 7,000. Not something we have seen just yet. In fact, pretty much we have noted the opposite, where the S&P is sitting at 5,579 points, down more than 5% year to date. We did also get a lot of bullish targets from many analysts, including Goldman Sachs, JP Morgan, the big banks who had this year end around 6,500 points, with even some others going as far to seeing this topping over the 7,000 mark. But lo and behold, as we say a lot of times, Wall Street analyst targets, they're all very reactive rather than proactive, and as the market has started to lower, we are also noting many of Wall Street following suit, with Goldman Sachs, Yardeni Research and RBC Capital at the moment being the ones that have lowered their targets, and we don't believe it will be too long if we continue this downtrend in the market, where we will see other larger names follow suit. And maybe you're someone in the Bank of America camp who believes the overall market could topple as much as 40%, where they believe right now stocks are in a bubble, and they've gone as far as to say it has exceeded the .com and Nifty 50 errors. But again, headlines like this is something we do get quite a lot as the markets start to drop even only a few percentage points. Perhaps you can give some credit to Goldman Sachs, where they said the S&P will probably return around 10% in 2025. Bear in mind, with their estimation, this is actually an inclusion of those dividends as well, so just on a share price return. So excluding those dividends, they do estimate it to in fact be lower, and they point this down ultimately to a slowdown in earnings growth, 11% this year and 7% expected in 2026. And at the beginning of this year, they reported that stocks are globally in a very vulnerable position, and it's very interesting to note, probably something that a lot of people do agree with, investors and analysts alike. But as we will come to show you, valuations have been getting quite exceedingly high, at least over the last 2 years, where a lot of gains have been made. But ultimately, what they boil this down to is that equities now, given their valuation, are priced for perfection, and it will be interesting to see if some of the larger companies, including the Mag 7, do start to falter as earnings season comes back around. Then we could perhaps see the market falling even further. Now, one of the things that probably is on everyone's lips are the words tariffs, and this has started some kind of global trade war amongst China, amongst Canada, as well as Europe, and this is also having an effect on the market. And just earlier today, when we did record our ASML in-depth deep dive, so check that out if you're interested, the market was sitting in fear. We are now back into extreme fear. Investors are feeling very, very bearish. As we already discussed, valuations are very high. Again, we're going to show you that very soon, but they're worried about the shorter term at least, given all of the talks of tariffs and the wider geopolitical issues. And just a few weeks ago, Trump said that he is not going to bend at all in relation to tariffs, something that he continues to add across different industries, across different countries, and this is something the market doesn't really like, especially given it comes with a lot of uncertainty. And he's gone as far as to say he's not even looking at the stock market, and believes ultimately in the longer term the tariffs that are being put in place, the ones that some in fact he has been increasing just over the last week, will end up making the US very strong. Again, that is up to your own interpretation, but let us know whether or not you agree with Donald Trump and that this will put the country in a better position. And just yesterday we heard from some new auto tariffs, which is essentially a 25% tariff on any imported passenger vehicle, and this also includes any parts. And we've seen a lot of companies that have already started to drive up their prices, something that will ultimately have an effect on the consumer and very likely drive up inflation, as we can see just from the release of the latest data for February, inflation progress has stalled and is still sitting below the 2%, which is ultimately the target, and therefore it's looking less likely that we will get interest rate cuts anytime soon. However, the market has priced in 2 for now. So what do we do when the stock market is falling? Is it a good opportunity to buy? Should we stay on the sidelines? Or maybe we should be selling? One thing that we know for certain, it is all about timing the market and not timing the market. Unless you have a crystal ball, it is impossible to buy the bottom. So what we have here effectively showing us the value of $10,000 invested into the S&P 500. If you were just purely invested from 2003 to 2022, that would have turned to around $65,000. If you missed the 10 best days, that would have dropped significantly to around $30,000. As noted, 7 of the 10 best days did ultimately take place in bear markets. If you missed 20, even lower, and as we can in fact see, if you had missed the 40 best days, you would have actually had a negative return on your overall investment. And for those that remember 2008 during the Great Recession, we can see that some of those days in fact were ultimately the best. October 13th and October 28th returning just double digits in one single day. And it's also shown here to the end of 2022 if you had missed some of the best days, the ultimate performance. So signaling right now, if you are someone with a very long investing time horizon, then perhaps selling in fact is not the best option at all, and either staying invested or in fact considering opportunities in the market to buy could be the right thing to do. And there'll also be other people who actually see this as a great opportunity just to buy ETFs, whether that's VO that tracks the S&P or for example SMH that is a semiconductor ETF, because ultimately when we look back at history, the average investor has typically tended to massively underperform the S&P 500. For example, 20 years, 99 to 2019, we can see the S&P up 6.1%, average investor up 2.5%, so there is underperformance, and again, this is something that we note even when we look at different data sets, so just something to bear in mind. Having said that, Tom Lee did believe just over the last few weeks, a large portion of this sell-off has been a massive overreaction, and as we highlighted earlier, he does believe a face-ripping rally is just around the corner. In fact, he says the odds of a 10 best day coming are significantly high, where he says the market right now is oversold, pessimistic, and a sizable rally is very near. Now, one thing we've just discussed is about companies having some very high valuations. Right now we're seeing this live as of today, and this highlights even with the continuation of the drop we are getting, companies still looking very high valued, and that is in relation to not just the overall market but also their own 5-year averages. But on the flip side to that, there are also opportunities that actually look very positive, very attractive, and this is what we ultimately like to cover on this channel. And something to bear in mind, the current S&P 500 P ratio is sitting at around 28. For those that like to compare that against historical data, well, the mean and median sit around 15 to 16, so even if we get a continuation of a drop in the market, they still wouldn't be anywhere near the historical averages. Again, doesn't mean it will drop, but just something we do want to make you aware. So what are some great opportunities that we see in the market? And these are names that we have talked about before. Just because they have lowered in price doesn't mean we see them as a bad investment. In fact, it makes them incredibly more attractive. We're going to run through just very quickly. The first one, Alphabet, which is down over 4% today. Now it's up 3% over the last year. Year to date, down 18%. But over the last 10 years, massive outperformance, even with the drop against the S&P, up 473%. Trading pretty much near its 52-week lows now, with a double buy from both Seeking Alpha as well as Wall Street. They also pay a dividend, but one thing we quite like is the forward valuation, which looks incredibly attractive, and also the lowest of the Mag 7. We also want to flag 17.4 in terms of their forward P is significantly lower than their average at 22.3. This is what we would call a severe undervaluation signal, and this is also confirmed when we take a look at this valuation model. What this highlights, the blue tunnel, is the expected price of Alphabet. Right now we see the company even lower than the bottom end of fair valuation. That is disparity showing us severe undervaluation. And again today, just very quickly going through them, so we want to show you our own process. We get to $226 for the company derived from the DCF model, where we have the free cash flow year on year including 2024. Average growth, this company sees 20% over the last 10 years on a year on year basis. We've gone for 12%, that is the middle rate, low, medium and high, 10, 12, 14. But remember, these numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others. but at 12% with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, 226, indicating 45% upside. Now we'll also show you for those that are a lot more conservative at 10%, 197 still upside of 26%, and for those that are a lot more optimistic at 14%, 259 indicating 66% upside. Now typically on the channel we like to take through the medium rate where we're not just done there because we always apply an MOS, 10% execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $203, then we keep going till it's near the current trading price, and ultimately we're saying that Alphabet right now has a 30% MOS, with Wall Street seeing this at $220 over the next year. That in turn translates to 41% upside. Do let us know though whether you see these stocks as a buy, hold, or sell, but what we're also going to do for those that believe actually that rate is too high, we're going to show you the margin of safety at 10% with the intrinsic price at 197, and you're still getting a nice margin of safety. In fact, it's coming to 20%, which we do believe, even at the low rate, is looking like a potential screaming buy. As we said, let us know your thoughts below. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can read straight away. And for those that are already subscribed, on Monday morning, including in the newsletter, we are also going to release a massive spreadsheet of all dividend kings. A lot of information, the upside that Wall Street see, as well as some very useful points. So as we said, make sure you are subscribed. We'll also quickly show you 3 other companies that we do believe are looking like a golden opportunity. Second one is Nvidia, up 22% over the last year, down 18% year to date. Over the last 10 years, massive outperformance, up nearly 21,000%, and we note it is trading in the mid to lower end of the 52-week range. A strong buy from Wall Street and a buy from Seeking Alpha. They pay a yield very trivial, 0.04%, and a forward PE sitting in the 24 to 25 region, which as we can see, significantly lower than their 5-year average. First signal here for Nvidia of a severe undervaluation. However, we notice that reconfirmed here for severe undervaluation given the disparity for the lower end and where the company sits, and also nice to see expected price has been increasing over the longer term, ultimately what you want to see from companies you're invested in. Now, intrinsic value is $162. As you can see, the rates we have used, 15, 20, 25, the 20% is actually lower than their 5-year growth rate, their 10-year growth rate, and the growth just seen in the most recent year. So you could even argue that is conservative, and that is giving upside of 48%. When we look at it in terms of a margin of safety, well, at 10%, a buy at 146, at 20, a buy at 130, at 30%, 113. Now, you're not getting 35% just yet, but we're saying Nvidia is showing a 30% MOS with Wall Street strong buy rating 177 over the next year, translating to 61% upside. Again, we'll show you for those that believe the low rate of 15% is more appropriate, what this is effectively highlighting to us, given it is near the current market price. Right now, Nvidia already baked into the numbers is a growth rate of 15% to their free cash flow moving forwards. As always, give us your thoughts. We then move on to ASML. As we said, we just earlier released a deep dive, so check that out. But for those of you that missed it, over the last year, down 31%, year to date, down 3%, over the last 10, up 569%, again, outperformance, pretty much trading near its 52-week low, massive pullback from its all-time highs over $1,000, double buy from Seeking Alpha and Wall Street, a yield around 0.8%, and a forward PE sitting around the 26 region, which as we can see, significantly below their 5-year average of 34, a massive severe undervaluation signal. And you can also say that given dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year, so 2 undervaluations to note here, and that's also reconfirmed as the company sits even lower than the bottom end. Now, our valuation comes to just over $1,000. As you can see, we've used a 14% growth rate, which does indicate 56% upside, and no surprises, a nice margin of safety will be in play. In fact, as we do go along today, you are getting at least 35% up to $686, with Wall Street fairly bullish, $940 price target, this in turn translating to 39% upside. Again, we'll show you for those that believe letting us use a more conservative approach is better, at 12% then moving forwards to their free cash flow, you are still getting quite a sizable margin of safety. In fact, as we look at 25% up to $690, that is looking fairly attractive. And for those that want 30% at this lower rate, it isn't quite there yet, so sitting somewhere between 25 to 30%. But again, it will come down to what you believe as to be the most appropriate growth rate. But if you believe these are reasonable, every single one of them giving us a fairly attractive upside. And as we noted, Wall Street indicating 39% just over the next year. And finally, although there are many companies in the S&P that do look very attractive, we have Meta Platforms down nearly 4% today, up 20% over the last year. Year to date, it was the only company in the Mag 7 that was actually positive. Now, in fact, it has turned negative, although barely 1%. Over the last 10 years, still massive outperformance of the S&P, up 613%. As of today, trading in the midpoint of the 52-week range, strong buy from Wall Street, buy from Seek Alpha, a low yield at 0.35%, and a fairly attractive forward P of 23 to 24, which as we can see is only very slightly below the 5-year average. So actually, unlike the previous companies, you could say Meta does look now to be reasonably valued, and that is something that is reinforced when we look here, pretty much sitting at the mid to lower end of the blue tunnel. And when we run it through our valuation, we get to around $700, which as you can see, we've used the lower rate in fact for Meta Platforms today at the 10%, and that is still showing signs of a 20% upside. As you can see, if you're more bullish at the 12 to 14%, the upside is 38 and 59% respectively. And don't forget, you can always, as we said, grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Meta Platforms or any others. But we'll also highlight, if you are looking at this company right now at only a 10% growth rate moving forwards, you're looking at a 20% MOS near $560, but we'd say sitting somewhere between 15 to 20, with Wall Street very bullish. They see this at $764 over the next year, translating to 31% upside. As we said though, do give us your thoughts in the comments below, whether you believe any of these are starting to look attractive, whether you've been buying any of your stocks, holding, or in fact starting to sell. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.